Good evening, ladies and gentlemen. It is 4 o'clock. There we begin our webinar on stable rupee. Present stability and future anxiety is a very interesting topic coined by none other than Mr. Thiagarajan. He is
Oh God.
today's keynote speaker. We have lined up expertise, experienced participants of the market over few decades to speak on this topic. Before introducing the keynote speaker and panelists, let me take a minute to introduce the FX First Basis, a new risk consulting company managing the value addition and risk in foreign exchange and international business.
You'll get a big person move.
I request everyone to go on mute. Please mute yourself. Thank you. Please mute yourself. In July, we started our FX First International FX First Basis. Mr. Pankaj Chitlangia joined me as a partner along with Mr. Sumant Prabhu. And we have been in business from the last 9 months. We have for our credit for hosting the Rupee Money Conference in December 2nd. Our strength is the very stable and strong research reports on currencies and interest rate risk. Recently, we have tied up with QuantEco to strengthen our reports on fundamental analysis. On our board, we have Mr. Thiagarajan, Mr. Yashwant Rao, and Dr. Shubda Rao. We consult strategic consulting on FX rates and interest rates. We are pioneer in outsourcing the FX treasury completely. We conduct global Rupee Money Conference, also like this. Thanks for all of you to participating in today's webinar. Now, I have a pleasure to introduce today's keynote speaker, Mr. V. Thiagarajan, chairperson of SOFX Treasury Foundation. Some of you who don't know SOFX, it's a short name dealing code of Syndicate Bank Treasury. Syndicate Bank presently merged with Canara Bank. Mr. Thiagarajan is a postgraduate in economics with an extensive experience and expertise in FX dealing, starting with Syndicate Bank, moved to Reliance to manage their FX flows. He is master trader of our time. In addition to it, of late, he is turning out to be a reputed economist too. He is an expert in technical analysis. He is our honorary faculty at Zen. His market perception and his trading skills, one should envy. And even today, he is very active in markets, maybe doing his own tradings. Let us hear him on stable rupee. And if you all recollect, I think way back, a few years back, he is the first one to say that rupee testing 80 in his interview with Bloomberg once, immediately after his retirement from Reliance. And definitely, everyone would keen to listen to him. And I also to know where the rupee is headed in the next 5 years. Over to Mr. Thiagarajan.
Okay. Okay. Thanks, Bijur. I think I got around 20 minutes. Okay, fair enough.
Yes.
Okay, at the outset, let me thank FX First Basis and QuantEco for giving me an opportunity. I think it gives me immense pleasure to present my perspective, readings and learnings. Actually, let us be very careful about it. Actually, I am not going to present my views or forecast. It is not going to be views or forecast. It's only going to be readings and learnings and perspectives. Actually, I think let us be very politically right. Actually, so basically the topic actually, as Bijur was saying, the past volatility, present stability, and future anxiety.
There is a webinar.
If some of you can mute. Okay, fair enough. the past volatility and present stability and then future anxiety, actually. I think what that summarizes the current mindset of the market. Actually, all of you who are attending this webinar must be having this mindset for sure. Because as a person in the market, I am having this mindset right now. So let us first define or possibly define the characteristics of volatility and stability and anxiety. Of course, all of you would have heard so many lectures on that, but still, volatility actually basically it's some sort of a dreaded word as far as Indian context is concerned. Actually, if some of you have been in dollar rupee market, if the dollar rupee goes up by 50 paise, actually naturally we all call that as volatility. If the dollar rupee comes up by 50 paise, we never call that as volatility, basically because it goes in accordance with what the predominant section of the market expects. So basically, whenever the dollar rupee goes up, it's volatility. There used to be a saying, when the dollar rupee occupies the front pages of the pink papers, it is volatility. That is the definition, actually. Anyway, come to think of volatility, actually, whether it is good or bad or ugly, actually, it is all subjective in nature, actually. You can draw your own conclusion. But in my opinion, actually, any volatile market is supposed to be more efficient market. Actually, some sort of a efficient price discovery is happening where the demand and supply determine the price. So basically, a volatile market need not necessarily be an inefficient market. That's point number one. Point number two, actually, currency volatility is disruptive. Yes, definitely. It disrupts plans, fair enough. But of course, it enables the efficient allocation of capital and keeps imbalances under control. At any point of time, it doesn't allow imbalances to go dominate the price action. Actually, basically, the currency volatility is disruptive. Yes, all of us know. That is why there is a hedging mechanism. You can hedge through options, forwards, whatnot. So basically, the episodes of volatility normally are disruptive. Of course, we'll see. And episodes of stability, that is where we are right now. It is actually possibly normally it doesn't seem to be a prudent to let the market. If some of you can mute. I'd say attempts at gating the currency are normally not seen prudent. Of course, it is not, as it leads to inefficient capital allocation. That's a basic point, actually. And then markets, basically they are willing to run massive currency bets if they think central bank has their back. Actually, we used to say the volatility, you hire a manager risk for managing your risk. In episodes of stability, you have a risk manager in the regulator himself. Actually, that's a basic difference. And then episodes of anxiety. Anxiety, actually, basically the unrealistic expectations by the participants are at the heart of stress and anxiety. In your normal life, when you get anxious, actually, basically, if you set unrealistic goals and you are not able to reach, naturally you are anxious about it. So markets as well as central banks seek to develop simplified, self-consistent version of the world. And that's a basic point. Actually, we think the markets think that the regulator knows all. And of course, there is a limitation to the expertise. You, me, anybody for that matter, there is a limitation to the expertise. That is where anxiety comes. So to sum up, the volatility is where you see the headlines in the pink paper. Stability is where you don't see any story on dollar rupee anywhere. And then anxiety is when you see a story in the normal press. Let's see, probably. Even in Times of India, first page headline, if it carries a story on dollar rupee, that is a period of anxiety. So if I sum up, actually, if I dovetail some of the behavioral finance principles with these three episodes, just see disruption, when the disruption, volatility happens, common sense is displaced by fear. When the complacency happens, common sense is displaced by greed. Actually, that is what we are in right now. We are not willing to pay even that 1.5% premium, actually. Uncertainty, when the common sense is displaced by anguish. This is actually basically, if you see your state of mind or actually possibly the dominant emotion in yourself, if I have greed, then naturally it could be a period of stability, it could be a period of complacency. Actually, reverse way you can derive in which state the market is staying. So right now, actually, we are all talking about dollar rupee. Actually, basically, it's not that dollar rupee has not seen all these three episodes. Actually, let's say episodes of volatility, stability, and then anxiety. Yes, all of them we have seen for about 2 years in 1993 to 95. We have been sitting at 31, 37. Can you believe? At least you guys are trading around 82, 82, so rather 82, 70 to 83, 30, kind of a 60 paisa range actually, whereas we used to be trading at 31, 37 all over the day for 2 years till about August 1995. So basically, this chart I have put out, actually, everybody knows this chart. You just see sustainable period of rupee depreciation, let's say 10 rupee depreciation. Actually, it's some sort of a arbitrary number that I am taking. 10 rupee depreciation, let us say 31, 37. August 93 to November 2007, at about 14 years it took for a. And then if you see a median period that is taken by dollar rupee for a sustainable rupee depreciation of 10 rupees, it almost comes to around 48 months. Of course, we can calculate it. And so anything that is achieved, any 10 rupee depreciation that is achieved or that is done within the 48 months, naturally it tends to spend almost the remaining period in a consolidative mode. Actually, 2 years back, we were at 72, right now at 82, 83, let's put it. And then possibly, maybe, actually, it will consolidate for a while. Actually, if you go by the history, actually, it is not a view. It is not a view at all. It is not a forecast at all. It is just I am extrapolating what has happened in the past to the future. And then say, possibly, I think this episode of stability can last longer. And then why nobody bothers about the dollar rupee? Actually, earlier, actually, there used to be a lot of stories coming up. Now, nobody talks actually. Possibly, this is the first webinar I think it has been done in the recent past. Just see, actually, when the dollar rupee, the merchandise trade, forget about actually the contribution of services to the current account and right now, actually, but still, the merchandise trade to GDP, this is the one ratio that should always be thought about. Actually, this is the impact on real economy. Actually, as the ratio goes higher and higher and higher, it has an impact on the real economy. That is why I am not a big believer in saying exchange rate stability makes macroeconomic stability or exchange rate volatility makes macroeconomic volatility. Absolutely not, at least in India's case. Basically, because the contribution of merchandise trade to GDP is at about 40, less than 40%. The global average is at about 50, 51, 55%. And possibly there are countries with 100% of it. So as the ratio is lower, so it doesn't have a big impact, dollar pay exchange rate. But you just see there are two episodes which happened, which impacted the economy, that is 2009 and 2013. If you see the peaks in this graph, that also coincides with. So basically, when the merchandise trade to GDP hits 40, 45 levels, then actually the exchange rate volatility has an impact on the real economy. Otherwise, I think exchange rate volatility or stability or anxiety, it doesn't have a big percolated effect into the real economy. And then we are all seeing actually, we are talking about the volatility in dollar rupee. Actually, this is the long-term graph. Just see the spikes. Actually, we are used to the volatility in dollar rupee. It is not that dollar rupee has never been volatile. And maybe in the last few years, actually, just see the volatility falling. Otherwise, we have been used to that volatile episode. So the volatile episode, to a large extent, it did not derail the economy for that matter. And right now, what is the kind of possibly the lowest volatility across across the emerging market space and possibly across the currency universe, but for some fixed exchange rate currencies. And then this is the kind of volatility right now that is there. And then, of course, we'll talk about the exchange rate regime. That seems to be some talk about that. Actually, of course, this is, of course, we all of us know what is the kind of exchange rate regimes that are operating. And then we are there at about, let us say, managed float. That is where we are there. Actually, that is what we presume that we are there. And then one point, actually, basically, of course, if anybody talks about this is the kind of exchange rate regime that particular country is having and particular country, and then we can anybody can adopt that country's exchange rate regime. It is absolutely not possible. Here, there is no size that fits all, because the exchange rate regime has to be fitted to the particular economy. And then there are no, actually, basically, in any economic literature, you will read about the experiences of Chile and Israel. Both of them introduced changes in the exchange rate regime. Chile got burnt, whereas Israel was saved. Basically, because it's an element of good luck, actually. Any change in the exchange rate regime naturally should be having a adequate luck. Basically, adequate luck in the sense, adequate support in the form of the external factors. So my final point is there is no sensible policy space involved in currency. So basically, we are not here to say this is bad and this is good and this is right and this is wrong. Absolutely not. So coming back to that managed float, and then what is the exchange rate policy regime of India? Actually, of course, the IMF came out with saying that you have become a stable regime instead of a floating regime. However, RBI has been disputing that fact. And then they were talking about December 22 to October 23, whereas actually September 23 onwards, that the stability has become more stable, actually. So right now, we just see that the dollar vehicle basically just see some sort of a perceptible change. Of course, this is the one point that I want to drive home. There is a perceptible change in the exchange rate management. Of course, as the graph shows, actually, I'm not saying anything. It's all commonly, that is the information that is available in the public domain. For instance, right from September 2023, this is going to be our possibly undercurrent in the next 15 minutes. Okay? Undercurrent in this presentation for the next 15 minutes. September 23 onwards, actually, there is a perceptible change that you can see. Of course, all of us have experienced, but of course, you can see. Otherwise, earlier, actually, there have been jerks up and down, and then possibly the dollar rupee has been moving around in, of course, in a particular range, but still there was some dynamic stability that was there. Now it has become a static stability. Of course, the stability, actually, we are dividing into two: dynamic stability and static stability. Dynamic stability gives that is, it possibly takes into account all the other factors that are predominant at that particular point of time, whereas the static stability doesn't take any other factor into the account, and then I am just targeting a exchange rate at that particular level. So basically, mark my word, from September 2023 onward, this has been the case. So what could be basically at the end of it, actually, when we are seeing something happening in front of our eyes, naturally we are asking for reasons. Actually. That could be, that is the human emotion. Actually. Basically, it is not that we are finding fault or anything like that. We are just trying to understand what could be the motivation for the stability post September 2023, whether it is going to end too soon or it is going to continue for a longer period of time. That's a two key questions for any risk manager in exchange rate. Actually. Now, of course, we will go on discussing these points. The first and foremost point is the unique nature of FX reserve. Actually, we are not built the reserves with the current account surpluses. We are built with the capital account surpluses. So the capital account surpluses. So basically, somebody has put money into the country. So basically, at the end of it, I will have to check my adequacy of reserves using the ratio of international liability to my FX reserves, rather than using that import ratio and all that stuff. Import ratio and all. Actually, for people who have constructed the reserves with current account surpluses or trade surpluses, whatever you call it. But for us, actually, basically, we have got the capital account surpluses, and then so many guys have put the capital in the country. So it is a international, is the ratio of international liability to FX reserve. It matters a lot. That, of course, it is not that it is some sort of a rule, but I am just trying to guess. Of course, I'm trying to guess. This could be one motivation. Number two motivation, actually. See, basically, any literature you go around, actually, 16% of the GDP, actually, even if you take China, 16% of the GDP is considered as a safe level of FX reserve for any EM currency under the managed float or a fixed exchange rate. So, 16%. So, basically, we have got two ideas. One idea is ratio of international liabilities to the reserves, and another idea is 16%. And third idea, see, basically, there is a desynchronization in global cycle that all of us know, actually. East is going another way, West is going in the other way. So what I will do, instead of sailing independently, I will anchor the currency to one of my largest trade partners. And then I will anchor my interest rate with one of my largest financial partners. It's a fair enough idea. Basically, at the end of it, as long as the anchor countries don't move from that exchange rate or interest rate regime, I also don't move. Possibly, it could be. It's a guesswork, I'm saying. And then the fourth point, actually, of course, I will leave it the floor to Vivek to discuss. Higher public debt invariably implies higher FX. It may be some sort of a sounding obnoxious for so many people, but of course, I have got some credible research backing this. When your public debt goes higher and higher, your FX reserves also goes higher, and of course, we'll discuss later. And then this could be macro reason and micro reasons. Of course, we all are talking about it every day. The possible preparation ahead of the bond inclusion. Yes, fair enough. Actually, I just want to be very careful. Yeah, fair enough. And then the probable goal to reclaim the FX reserves, $691 billion was the highest level of the FX reserves. That is spot plus forward. So I will achieve that first. After that, we will talk. Possibly that could be one of the reasons. And then a third reason, actually, of course, it may look very silly. A lower cost of holding the reserve. Well, I am anyway getting 5.25% in a dollar interest rate, and then my negative carry is so low. It doesn't make a big impact on my balance sheet. So basically, I will go on accumulating reserves. Possibly. This is how the reserves are. Of course, this is actually this graph you can see anywhere. And then we come to that first point, what I told, ratio of overseas international liability to FX reserve. You just see this graph. Possibly at about 50%, they may loosen the grip as far as the intervention is concerned. Possibly. This is how the ratio has worked out so far. And possibly, of course, it is only I can't call it a speculation. I can call it as a guesswork. Possibly, actually, this is one thing that the markets can watch. And then I was talking about this highest level of reclaiming highest level of reserves. You just see 691. And possibly that thereabouts, actually, we will go and stop. Yes, possible. And then you just see the current level of reserves. Actually, reserves, when you say I am adding both the spot as well as forwards and then arriving at right now at 630. And then possibly as we go into 690, actually you can expect the defense to be, the grip to be loosened. Actually, this is one chart, actually, probably, I think all of you, it's all drawn from the bulletin, actually. There is absolutely nothing, it is not from my hat. You just see the kind of numbers. Actually, I was talking about the September 2023. Post September 2023, the kind of numbers you just see actually is all galloping. 27,757, 29,625. And then if you see the graph, it is much more very, very clear. This is the total purchase and sale of RK. And this is a forward outstanding. So basically, you just see the sharp climb in September 2023 and consolidation thereof. That means your activity in FX spot market is higher. And then forward outstanding has been lower, actually. Fair enough, actually. I don't want to get into that. But the only thing I want to say is September 2023, I wanted you to note when that graph. Now, September 23 onwards, actually, the total purchase and sale have been higher. And then September 23 onwards, what has happened in this international markets? You just see possibly a dollar CNY, I'm putting a graph, and then you just see where the CNY was. Possibly from September 2023 onwards, 735 got defended big time. And then possibly this could be one of the motivations. That is why I'm saying the currency anchor with CNY. Possibly this could be one of the reasons. And then if you want to understand what exactly dollar rupee is going to do, maybe because see 135, you just cannot deny the fact that we are having a trade deficit to the extent of $135 billion, if I'm correct. So basically, just see CNY at the same level, consolidating at the same level, at about the same level. So basically, that gives you a very good idea about what's going to happen in dollar. And of course, September 23, actually, I am repeating, basically September 23 onwards, the total purchase and sale have gone up. And the total, of course, it could be a coincidence that September 23 onwards, China has been defending big time. And then September 23 onwards, actually, this JPM news has come. JPM bond inclusion news has come. So basically, maybe these are all the factors that could be behind the kind of static stability that we have seen. And then another one point that I told, actually, that 16% of reserves, 16% of GDP as reserves. Actually, if you see, most of the reserves, actually large reserves, you just see actually everybody, the fixed exchange currency, actually these guys will be having the large reserve. Flexible exchange rate currency, actually possibly they will be holding a lesser reserve, actually, if you go around the place and see. So normally it is considered 16% is a safe level. 16% of GDP, it comes to around 640 billion. Possibly there I will stop. And then the last point, actually, basically, maybe actually some of you may not be able to relate. The only thing is if you public debt to GDP, if goes higher in any currency, naturally reserves also tend to go higher. So if the public debt to GDP, if it goes to, let's say, 88%, and possibly, let's say, 900%, naturally, it is some sort of a balance sheet management, macro balancing happening, actually. You just look around the world and see who are all holding the higher reserves and what is their public debt to GDP. Two names come to your mind immediately, Japan, China. What is the public debt to GDP? So basically, as the debt to GDP goes higher, reserves also go higher. Maybe actually, it may or may not be valid, but of course, it's an unconventional kind of this thing. I think I will leave it to some of the economists to talk about it. Actually, basically, maybe I think work on it. Public debt to GDP, if it goes higher, reserves will go higher. Actually, on the face of it, it looked irrelevant and ridiculous. But if you go behind the numbers, actually, possibly, it looks more credible. And then there where I end, actually, basically, the point is actually 640 to 690 billion dollar reserves. Actually, you can very well think as some sort of a cushion that the authorities want to have before getting into this bond inclusion thing. Actually, basically, this stability thing, it's going to continue for some more time. Actually, there is no doubt about it. Actually, that at the end of it, the stability, of course, the another point, actually extrapolating the history, and then you are getting around 48 months for a sustainable 10 rupee depreciation. That means actually, if you take, let us say, now 2 years have passed by, another 2 years actually possibly it could remain stable actually. If you extrapolate it, actually possibly this kind of a range trading actually can continue for, let's say, 2 more years. This thing. So these are all the key takeaways. Basically, the bond inclusion, the China thing, and anchoring a currency to east, anchoring the interest rate to west. I think that looks, on the face of it, it looks correct. Possibly, we may not be able to make out exactly whether it is happening. So, in summary, that is the last word that I have written. I frankly do not see much in the history to justify the hopeful view. But you ask anybody in dollar rupee market, no, rupee won't go anywhere. That will be the first simple answer everybody will give. So that extreme fluctuations have been passing aberrations unlikely to occur. So basically every time actually you have to fasten your seatbelt and then possibly sit tight and then do your risk management. Thank you so much. Over towards, I think possibly the panel will elaborate on the further discussions. Thank you. Bijur?
Thanks, Thiagarajan. The depth of work and the data you have is amazing. And the market, as well as I know, you will not come without preparation for any speaking. Thanks once again. And I will take one question for shortage of time. You can raise your hand. I will unmute them.
Mr. Ganpati, I think, is raised his hand. He can unmute and ask question.
Yeah.
Yes, Mr. Ganpati.
Unmute yourself. Mr. Ganpati, unmute yourself.
Yeah.
Yes, sir.
No, I don't have any questions, sir.
Oh, God.
No problem.
Okay.
Nobody is asking question. I think we should ask Dr. Shubda to ask question.
No.
Any panelist can also ask.
Madam.
Yes.
Yes,
Sir,
madam.
yeah. So my question now, you were telling like, interest rate, they're anchoring to west and currency to east. So what if there is like, divergent policies, because China is not raising rates and, west raises rates and China does the reverse. So then will there be a lot of dichotomy between monetary policy and fiscal and monetary policy and currency exchange rate policies?
No, I'm trying to guess actually. Basically, it's not that actually. I'm not saying that this is happening actually, but I'm trying to guess. Basically, just basically anchoring the currency to east and anchoring the interest rate to west. I think there is no dichotomy at all. Actually, basically, okay, fair enough. There is no other choice. Desynchronized global business cycles, actually. Can you ever believe that China will be going down dramatically like this? At the same time, global growth will be holding at 2.5 to 3%? No. At no point of time we have ever been taught in the schools. If China is the leader of global growth and the Chinese growth is going to matter much, and the Chinese deflation will kill the global inflation. These are all the theories that we have been taught. But in my view, actually, basically, I think this is going to continue. Basically, 735 at no point of time, 735 is going to actually China possibly. I think we can confidently say they are going to live actually. $4 trillion reserves from 4 trillion, actually, they have come down to 3.2. And then possibly, I think they will continue to defend the 735 barrier for long. And if that be the case, actually, possibly, we also could be in a period of stability. Actually, basically, it is not that the currency could be following. Currency could be it is not getting anchored. Well, let me clarify. Actually, let me not use the word anchor. Possibly, currency could track. Currency could track or dollar CNY, whereas the interest rate, you just see May 22, the sudden rise in the rates actually preempting Fed 75 basis point. And thereafter, actually, we never go, actually, possibly we are just waiting for Fed to ease. Only then, actually, possibly we will be easing. So monetary policy is in a different track, and then currency is in a different track. Absolutely.
Thank you, sir.
Thanks, Thiagarajan.
Yeah.
Before going to the panel discussion, I'll take an interruption of 5 minutes to introduce about what we do in Zen-Mastering the trading program of First Basis, and also the FX Periscope report, which we recently introduced along with QuantEco. My colleague Tauri Sheth, marketing coordinator at First Basis, will talk on Zen. Over to you, Tauri.
Thank you so much, Vijay sir. I'll just share the screen. I hope everybody can see the screen. Okay. Good evening, everyone. My name is Sabri, and I'll be speaking a bit about our trading program, Zen Mastering the Trading Game, which is brought to you by First Basis. So in this 3-month course, delivered every Saturday and Sunday through live online sessions, we offer a comprehensive approach to trading that goes beyond technical analysis. So at Zen, we understand that successful trading isn't just about mastering charts and indicators, it's about mastering yourself. And that is why our program begins with mindset coaching, focusing on topics like stress management, overcoming mistakes, goal visualization. We delve into the psychology of trading, empowering you to psych yourself for a winning career and equipping you with the tools to create your future. But Zen isn't only about the mind, it's also about the body. So we also integrate physical fitness training into our curriculum. Of course, we also provide technical training covering fundamental as well as advanced topics such as trend lines, candlestick patterns, options trading strategies, and Elliott wave theory. Now, our industry leading faculty and coaches will be guiding you through these concepts, ensuring that you develop the skills necessary to become a master trader. Now, what sets Zen apart is our commitment to practical application. So, we don't just teach theories, we trade together and we make money together. So, whether you're a fresher interested in trading or an experienced trader looking just to hone your skills, Zen offers the opportunity to develop new abilities or hone existing ones in a collaborative environment. So we already have successfully completed 10 batches of Zen, where bankers from Union Bank, RBL, Bharat Cooperative Bank have participated and trained, and others from Wipro, CPCL, HPCL, and even IIM students have opted for this course. Now, our 11th batch will be starting super soon, and we only have limited seats available. So you should register as soon as possible. Our contact information will be mentioned on this slide as well as in the chat box. And you can mail me at zen@firstbasis.in. So this was about our trading program Zen. Over to Alanis, who will talk to us about Periscope.
Hi, good evening, everyone. I'm Alanis, and I will be delving a little bit into FX Periscope. First Basis and QuantEco Research have partnered up and introduced a comprehensive research report on the Indian economy and the INR, aimed at providing a clear perspective on currency markets. These reports are designed to deliver significant value by supporting business growth and enabling proactive risk management strategies. Our technical analysis is presented by Mr. Yashwant Rao, a highly respected authority in currency and commodity price risk management, with an impressive background that includes serving as the head of strategies for commodity price risk management at RIL and working as a forex consultant to corporates at Patterson & Co. Mr. Rao brings extensive experience and invaluable insights to the table. Currently, he serves as an expert consultant for commodities and forex at First Basis. Our fundamental analysis is conducted by a panel of experienced economists, Dr. Shubhda Rao, who is the founder of QuantEco Research, Mr. Vivek Kumar, who is the co-head research at QuantEco, and Yuvika Singhal, economist at QuantEco. These esteemed economists contribute their expertise to provide comprehensive insights into the fundamentals of the market. The FX Periscope report is a subscription-based service that is released on a monthly basis, providing subscribers with timely and valuable information. Additionally, we conduct quarterly meetings with the QuantEco research team to further enhance the depth and quality of our research. For more information about our FX Periscope report service, please feel free to contact us using the contact details provided on the screen that is shared or in the description box in this chat. Over to you, Mr. Vijay, sir.
Thanks, Savri and Alanis, for that brief. We'll quickly go to panel discussion. I would like a very brief introduction of our panelists, starting with the youngest panelist, Kunal Sodhani. He is the vice president at Sinan Bank. He has all the quality about Zen trading, that they told to become a master trader. Okay. Presently, he is managing the flows at Sinan Banks, and he is known for his daily briefing. And he won several awards in the treasury contest. He was continuously winning the currency dot award in first basis currency dot contest. And bit about him, he's a very focused guy, does a lot of hard work to bring out the reports which you are all reading. Behind that, a lot of hard work is done. I like him, to encourage him and to hear him. I requested him to be one of the panelists. He is willingly accepted it. Thanks, Kunal. Looking forward to hear you. Yeah, we have Madam Tanushree Bagrodia, Chief Financial Officer at Lakshmi Organics, a banker turned Chief Financial Officer. And the subject matter which we thought is, she's the right person to speak on how the stable rupee affects the corporate like her. And she's known for her contribution to both at the banking industry and the corporate sector. I've heard in our 2022 Rupee Money conference, she spoke very interesting about the options and all. Looking forward to hear you, madam. Welcome to First Basis for the panel. Then we have our own Mr. Vivek. Vivek is emerging as one of the leading economists in the country, and his reports, periscopes, or even panel discussions earlier, people have appreciated. And his views about the rupee is on the dot this year. And Vivek, welcome to the panel discussion. Then we have Mr. Pankaj Chitlangia, my colleague and Chief Executive Officer at First Basis. Pankaj himself is a option trader, and he had over 2 decades of trading experience in foreign exchange markets, as well as he is an expert in wealth management. Over to Pankaj Chitlangia.
Thank you, Mr. Biju. Thanks for the introduction. So we'll spend next 40 minutes delving into currency markets and interest markets, and we have 3 experts, and rightfully each from different spheres of things. Like one is a banker, one is a corporate treasurer, and one is an economist. I'll start with each one of you to give maybe 5-6 minutes of your view on the currency markets and how you are looking into the near future. And then probably later on, we'll delve into more into how we can use those information to kind of manage our risks. So I'll start with Kunal. Hi, Kunal. If you can probably give us some insights on what you think about the rupee markets and what's your view on the rupee in the near future.
Right. So first of all, thanks to First Basis for having me here. It's indeed my pleasure more than First Basis, I would say. I'm just a learner, and I look forward to develop this market considering my passion towards it. So I'm game on when it comes to FX. So I would just begin by saying that there are decades when nothing happens, and there are days or weeks when decades happen. So when we go to COVID time, we have seen that no one was expecting some kind of an event coming like this, and some days or weeks change scenarios. And if we talk about a current scenario of stabilization of rupee, where nothing is happening as per traders or maybe the hedgers, where people are sidelined. But the point is, risk does not come knocking the door. It's just one fine movement, a couple of weeks, which can change things. And particularly when we talk about financial markets, things go wrong more often than they go right. So it's quite important to follow a prudent risk management policy internally, irrespective of what the view of the market is, or what is my personal view, or maybe other economists or bankers' view maybe. But ultimately, it is your money which is delving into your business. So my first point to begin is consider trading or hedging. Particularly exporter and importer who is managing the business, don't take currency as a proposition of winning. It's about purely hedging your FX risk. There is a very wafer thin line when we distinguish between hedging and speculation. Many hedgers don't even come to know when they have started speculating, because they don't have a prudent risk management policy. So it's about, when you are into a business maybe of textiles, you need to make more money out of, or make more alpha from your own business and not from currency as a business. So that's first for corporates particularly. But let's go, as the question is, towards what is our view. So first of all, on the domestic factors, if I talk about the FPI flows in India, from Jan to March, we have seen like a stagnant flow or maybe flattish flow from equities of around 2,000 crores. And if we talk about debt, we have seen around 52,000 crores of flows. For the March month, we have been positive. And for rupee as a currency, flows remain an important factor to consider, which are capital flows or flows when it comes to Indian debt or equity markets. On the other hand, if we talk about CPI number, which came in at 5.09% in Feb, which was 5.1% in Jan, so almost a stagnant inflation, which we have seen. But two, three things which we have to watch out is the food and beverages, which is still remaining above 7%. Though it is into the range of 2 to 6% of the RBI comfortable band, and we foresee it to be in that band for some more time going ahead. But this factor has to be considered. In fact, food inflation has also, the core inflation, I would say, has also cooled off to 3.5%, which possibly was last seen in January 2015. Next inflation figure for March, we are expecting that the CPI number may come at sub 5, because possibly there was a scenario where we saw a cut in the LPG prices. Thus, fuel and light may come lower, but some pressure may be there on the food inflation. FX reserves, as rightly highlighted by Thiagarajan sir, that obviously it remains an important component. Just to add on to him, if I see historically when the COVID period started, FX reserves were somewhere roughly around $450 billion. From there, it grew and made an all-time high of $645 billion. That was October 2021. Then in October 2022, exactly 1 year after 2021 of highs, it went towards $525 billion. And currently now it is standing at around $625 to $630 billion. So definitely it creates a visionary picture where the inflows which we have seen in 2023, if we talk about 2023, we have seen the highest ever inflows in Indian market to the tune of maybe around 1.7 lakh crores. That is the historical highs. And I would also commend that central banks possibly have made a very good use of it by accumulating those inflows and getting our FX reserves once again higher. The question is there a need for FX reserves, or is it's any barometer? Possibly no. But yes, during uncertain times, these reserves are definitely helpful. Considering this year have Indian elections, we also have US presidential elections. We have elections in two major countries which are at a risky stage, that is Ukraine and Russia. Both of them have the elections this year. So considering some kind of uncertainties which possibly may prevail, apart from the Middle East crisis which is arising from the Red Sea, it's important to have enough reserves in place to fight in case if required. So from that perspective, I see it as a good sign that without much depreciation of rupee, we are able to accumulate reserves. Also, if we talk about the GDP number, we saw the Q4 number coming at 8.4%. For the year 2023, it closes around 7.7%. For year 2025, I'm anticipating it to be around 7%, which is also tremendous considering other economies and how they are performing. Moving to the bond indexes, that is JP Morgan and Bloomberg. So JP Morgan obviously will begin from June 2024, and the anticipation remains that possibly to the tune of $24 billion of inflows may be seen. But markets are always forward looking. Markets always discount these things in price. And again, it is not going to come in one go. It's coming in a staggered manner of 10 months. So it's not that one fine day things will change and rupee may go to 78. That's maybe not going to be the case. But as I said, obviously these flows may have some knee-jerk reactions, which can benefit a trader or an exporter and importer if they are wisely hedging the strategies well. Also, with Bloomberg coming into picture now, which they will begin from Jan 2025 to maybe October 2025, some flows will be attracted from that perspective. Let's talk about the global factors now. We had a couple of job data points. Yeah.
1 minute more.
Sure. Yeah, 1 minute more for me. Okay. So if we talk about the global factors, obviously it's about a decision of how Fed is moving about when it comes to interest rates. Personally anticipating it to be in June, considering the labor data points which have been weaker. The NFP was the only number which came in better, but the CPI number also came in at 3.2%. Even ECB, the people have been a bit hawkish, now turning a bit dovish that possibly next month may have some kind of rate cut. To sum this up, overall scenario, I would say two things. One, to have a view on dollar rupee is not an easy task considering how the things are managed. But personally, that's my personal opinion again. I'm not an expert, but personally, I believe we will see on an appreciating phase with 83.30 possibly acting as a resistance, 83.30-35. And personally, I'm levels of 82.35 to 83.5 to be tested. Just to conclude, I just want to say that whenever any poker player goes to play, if you play into a poker and if you are out of chips, you are out of the game completely. Similarly, when it comes to trading or even hedging, it's important to understand two things: when to hedge and how to hedge. This when aspect should be disciplined so that you don't run out of chips. The problem is we go all in all time. That's the problem which hits. And lastly, there are 4 principles which personally I believe every trader, every hedger needs to follow. Is one, there is always uncertainty. There will always be a case where the market timing will be uncertain, but you need to act and you need to hedge your strategies in a clear direction. Secondly, if you believe that leaving or going all in will never help, so clearing that strategy is important. Every decision should be taken as a consequence. It should not be taken that, there can be possibilities that there can be a lag and cause effect. It's not necessary one event will have an immediate impact. So prudent strategy, hedging strategy is what I would suggest to everyone. Yes. So over to you, Pankaj. Not taking much time here now. I understand we are short of time.
No, we'll extract more from you as we go along.
Sure.
I'll invite Tanushree to give her views and probably touch upon how particularly corporates are looking at this market. Pretty much stable. Are you, as Tyagu said, maybe complacent range. So over to you.
Thanks, Pankaj. I think before I talk about how corporates are looking at life today, right? When Mr. Thiagarajan presented that graph when he was talking about the merchandise trade to GDP ratio, one thing really stood out for me, which was that the big peaks were in 1966, 1975, and 1992. And I think that really took me back to saying, what's the journey that the rupee has actually done post-independence? And what struck me on that graph was because that graph started at 1960. So till 1966, the rupee was actually first pegged to the pound and then the pound to the dollar, and hence the derivative, and hence the rupee dollar was derived. So where we started, I think in 1947 at roughly about 3 rupees, the dollar INR was at about 3 rupees. We came to 1966, where we then became about, I think it was $7.5 rupees to a dollar. And even back then the next jump that came in 75 is due to, and there are more experts, but this is my understanding of the market, is due to things that we see today. 75, we'd finished 2 wars, one with Pakistan, one with China. It was the global oil markets that were doing their yo-yos. And so from 7.5, we went to about 8.2. And then this was in 74, right? And then the subsequent political instability in the country, which led to a significant amount of borrowing that we had, led us to 1992, when 40% of the government's revenue was earmarked towards interest payment. And, this is also what Mr. Thiagarajan was talking about, that when we are borrowing and when we have revenues, the interest expense should be a minimal. So I think those are my reflections as I was hearing him speak, because life hasn't changed. And, his last slide was perfect. He said, history doesn't say that none of these aberrations are not going to repeat. So we need to be prepared. So nothing that has happened in the recent times. So I was not born in 74, for example. I was not there in 47. I was not there in 65. But one studies history, right? So I think whenever we look at life, and when we look at history, we look at certain events which are very, very probable and extremely plausible to occur, right? And I think as CFOs, safeguarding the wealth of the companies that we work for, right? I think it becomes our job to be able to predict or to be able to understand what are the high frequency events with a high probability that will happen, and to be able to ensure that we protect against those. Then we look at the high impact events, which are probably very difficult to predict because they've happened once in a blue moon, right? But then we have contingencies for that. And then there are low probability, low frequency events that we can absolutely leave out because, it doesn't make sense to sort of look at those. So I think that becomes the role of a CFO to really be sure that if history has taught us something, we absolutely cater to that, prepare for that. We don't believe that, these were aberrations and they won't happen again. We also have enough of chips with us, as Kunal put in, to ensure that if a low probability event happens, we are agile and nimble enough to be able to tackle that. Now, I think the second aspect that comes in is, again, and I totally agree with Kunal. I've been on the banking side, and I actually started my banking career selling derivatives and options to corporates. And this was in Europe, and I have seen how in 2004, 5, and then during 2007, 8 global financial crisis, the world just went berserk, right? Nobody was really thinking about, everybody was looking at the optimistic view, and nobody was really worrying about this being a downside. And I think what's the most stark from that learning for me is that in that period in India, bankers were selling derivative contracts to CFOs who were willingly buying them because that was being considered as a money-making opportunity. And a lot of corporates lost their shirts off the back. So I think that's the second part, that as CFOs, we need to understand that, yes, treasuries have a budget and treasuries can be profit-making, but that's not our job, right? It also depends on our own internal credibility, our internal capability. What kind of people do we have? What kind of infrastructure do we have? And hence, what is it that we risk? So, just as individuals would define their risk-taking profile, I think every corporate needs to define their risk-taking profile and then take actions, right? Coming to where we are today, I think, in my career, if I look at the last 10, 12 years of rupee dollar movement, and my career has been longer than that, but if I just remember that 10, 12 year period, rupees potentially depreciated about anywhere between 2.5 to 3 rupees on an average in that period, right? And then, of course, there have been periods like I think it was Jan 22 to November 23 when the rupee just suddenly depreciated 12%. So of course they are there, but over a period of time, it's 2.5 to 3%. I think today I couldn't agree more with Kunal. It's a stable period. I'm not going to repeat all the reasons that everybody has already said, right? Inflation's coming under control. People are saying interest rates are going to start coming down. Of course, I think India there is a consensus that we will have political stability. The world will be a very interesting place to watch out for if we have Trump winning in the US. But I think barring any other shock and barring the Red Sea event or the Israel-Hamas conflict blowing out of proportion, I think the rupee is fairly stable at the moment. It's at 82,825 today, and it's been hovering in that range, and let's say it'll hover in that range. So as a corporate, while you're watching out for these events in the markets, I think what we are also watching out for is what is happening to different economies. Where is our risk, right? So today, as a corporate, and this is all public information, Lakshmi Organic is a publicly listed company. We are a net importer, and that means we're actually very happy saying that the rupee is stable, that the rupee is going to appreciate. But I think we are also not looking at just the fact that we are a net importer. We are looking at our exports gross. We are looking at our imports gross, because the timing mismatch can also create a risk that we don't want to take on our books. The second is, with the forward premium going likely to go up, there is an opportunity for us to be able to earn that premium which had eroded. On the flip side, it was nice to be able to hedge your imports and not pay a high premium. But the time to now balance that has come in. But I think for us, what's even more important as an organization, right? We're in a heavy capex mode. We've announced our largest capex of about 700 crores in the next 3 years. At which point in time, there are a lot of bankers who will come and tell us, "Arey, ECB le lo." Now, at the face of it, and they will also say euro mein le lo. Right now, dollar doesn't make sense, so they will come and say euro mein le lo, because the interest rate arbitrage will still be there. But again, one looks at the fact that you're a net importer. Keep that aside. Even if we were to take an ECB in euro, I think I would then weigh it against the cost of debt in rupee terms, right? Because you can't look at an interest rate in euro and an interest rate in rupee. So I think vigilance is a must. Monitoring market is a must, but understanding business and ensuring that you are not aggravating the risk that the business anyways has is the job of CFOs in this time. It was far more difficult in 2023 when the market was so volatile. When you were really sitting on tenterhooks and you were saying, we are a cost center as a treasury, we're not a profit center, and we've got to ensure that our losses are the bare minimum. But at that point in time, we took a very, very prudent approach in saying, we will protect for our worst case scenario, because we don't want that worst case scenario to happen. So we are going to protect for that. And which means defining our own risk appetites and our own risk-taking comfort zones and playing within that.
Thanks, Tanushree. We'll pick your brain more on what a corporate should do as an importer a bit later. I'll ask Vivek to chip in. Vivek will definitely have more to speak about economics. Vivek, over to you. I'll also ask you to touch upon a little bit on the US, how US is evolving in terms of rates. What your thoughts about those parts as well?
Hi, Pankaj. Good evening, and thanks for having me here. So, just briefly touching upon what Thiaguji said, the topic is past volatility, present stability, and future anxiety. So, in terms of past volatility, I mean, if you scan the rupee universe, especially since liberalization, then rupee has seen 4 major episodes of extreme volatility. One was during the Asian crisis. The second one was the global financial crisis, Lehman crisis, as it is also known. The third was in 2011, 2012, when the recovery was happening post the global financial crisis, and that period was accompanied by extremely high commodity prices. So I do remember that 2011, 2012, the Brent crude prices touched almost 105 on an average basis. So that was the average price of crude for the entire year, and that was the highest that India has ever seen in its history. So that was the third episode. And last but not the least was in 2013-24, which was also the taper tantrum episode, and where India infamously got clubbed as a fragile five nation. So out of these four major episodes of extreme amount of volatility in rupee, I think what stands out, Pankaj, is the fact that three were clearly global in nature. One was to a large extent domestic in nature. So when I say global in nature, as in we kind of imported those shocks, and the rupee, because it is the single most important barometer of global financial market risk appetite, it took that on almost at its face. The last one, which was more domestic in nature, because all the excesses which were kind of getting built into the economic system post the global financial crisis recovery, had led to a lot of instability in the economy. And by instability, I mean both external sector instability as well as internal sector instability. By external sector instability, I mean what Thiaguji also touched upon briefly was the trade deficit ratio kind of ballooning. So I would probably, take a slightly more holistic view and say that current account deficit was a problem. So we were running almost 4.5-5% current account gap at a time when it looked to be slightly more challenging to fund that gap. So it was just the beginning of those times. And this was the external sector imbalance. The internal sector imbalance was reflected in your very high inflation numbers. So we were repeatedly touching 9%, 10% inflation on the CPI. We are not talking about WPI here. So both these imbalances started to weigh. Investments had started to slow down initially. I mean, initially post the global financial crisis, there was a step up in investment, but soon after that, fatigue had started to set in. That had started to build up, at least started to reflect in corporate sector balance sheet. And as a result, growth momentum had started to come off. So this was, I would say, to a large extent, domestic driven crisis, which got reflected in rupee. And the trigger was in the form of taper tantrum, because Fed said, I want to now not inject the same amount of liquidity that I'm doing. In fact, what I want to do is that progressively I'm going to take off the liquidity as we move forward. So it was not even tightening. It was just that the Fed saying that I'm going to take off the incremental liquidity which is there in the market. This itself was, I think, enough for some of the risky assets to move in a tailspin. And since rupee had a very vulnerable macro backdrop, it kind of took that beating at that moment. So these, according to me, one was the past episodes of volatility and how they differed in terms of the origination of the shock. The fast forward nearly 10 years, and now we are in the state of present stability, something which Thiaguji said, especially September 23 onwards, and it's very much reflected in data. So even if you go back a little bit beyond September 23, then you would notice that the rupee volatility is not just relative, it's also on a historical basis. So, so a lot depends upon how you define volatility. So volatility can be historical, which means that given your own past performance, how are you performing now? So that is historical volatility. This volatility can be relative, which means that, forget about history, I'm looking about peers. So this is what peers are doing. And in that context, I'm extremely low in terms of my volatility. There's another third angle to volatility, which I'm sure traders like you, Pankaj, because you deal with options much more, is the not the realized, but imputed volatility, which is kind of derived from options. So we're currently keeping that aside. And we are looking at both historical as well as relative volatility in rupee. In both cases, rupee turns out as an outlier. Both in case of historical volatility, we have not seen these kind of volatility numbers in rupee since the Asian financial crisis. And on a relative basis, also, rupee kind of pretty much stands out as one of the most least volatile currencies in the last 1 year period. Maybe one or two currencies might be better, but I guess on a consistent basis, that has been the trend. So what is really driving this stability? Now, I would agree with Thiaguji that it's very difficult to pinpoint and say that A, B, and C is behind this present bout of stability. Well, at the face of it, there is macroeconomic stability in the country. I think Kunal also did mention about this nearly 7% GDP growth. You have inflation, which is slowly gravitating towards the target. Our debt problem is high vis-a-vis some of the emerging market countries, which is more a stock problem, but our flow problem, which is fiscal deficit, is relatively much better than most of our peers. Well, largely because we did not go all in the post-COVID stimulus program, so that had some benefits as well. And last but not the least is the corporate sector balance sheet, which now probably looks much more healthier than what it used to look pre-COVID. So from a both macro as well as from a micro angle, the economy looks to be in a much more better footing, which is natural to be kind of get reflected in the currency market volatility and in the currency market rates. That's one angle. But on the other hand, if I can maybe take a slightly more audacious approach and maybe take a slightly more bold call here, then while macros are fine, you could also ascribe a large degree of micro intervention from the RBI in trying to keep rupee stable. So September 23, there has been a phenomenal degree of increase in RBI intervention, and the intervention has been two-sided, which is extremely remarkable. So on a net basis, if you see, the interventions are of the order of just $1 to $2 billion. Whereas on a gross basis, if you see, the interventions are of the order of $30 billion nearly for the last 3-4 months. And I was trying to see what is this $35 billion of gross intervention amounting to. So what we did was we looked at the merchant market for USD INR, the merchant spot market for USD INR, and both buy and sell put together. And we juxtaposed that with RBI's buy and sell, which is basically gross intervention. And we found that RBI's buy and sell is almost as high as 40% of the merchant USD INR buy and sell market. So that's phenomenal. RBI is clearly the biggest elephant. I mean, it was the biggest elephant in the market, but it's much bigger than I think most of us would have thought a year back. So RBI is extremely active. To the point that one could probably take a harsh look and say that it's almost paranoid, and it's trying to control volatility to that extent. So next, the question is, I mean, we've been through past volatility. We are in a state of extremely stable zone right now. What about future anxiety? And I'll probably, borrow a cheeky line from the movie Dabang, which talks about thappad and pyar. So you could say that volatility se dar nahi lagta, lekin stability se dar lagta hai. The least amount of volatility that we saw was pre-Asian financial crisis, and post that we saw rupee moving in a tailspin during the Asian financial crisis. The point here that I'm making is, if at all there is a crisis, it would be difficult for RBI to keep the currency in a very tight range that we've seen in the very recent quarters. And one of the motives, I think, what Thiaguji also touched upon was maybe that few things have happened in the last 6 months. One is India's entry into the global bond index. And to me, that's a very seminal change, which a country like India is currently going. Post 2013, when we saw that extreme amount of rupee depreciation during the taper tantrum episode, one of the triggers or the channels through which it was manifested was FPI selling in debt instruments, and these instruments were largely short-dated treasury bills, etc., or short-dated bonds. So since then, we have been extremely cautious of allowing debt investments into the country, and it's only been in the last few years that we've been taking one step at a time. The listing in the global bond index has actually something not which was consciously targeted by policymakers. Yes, we've been liberalizing to some extent, but India actually stood firm in its ask of not giving or certain concessions as far as tax rebates are concerned. And despite that, the global bond index providers have actually gone ahead and listed India. So basically what is happening is that from a currency market perspective and from a macroeconomic perspective, the arena is now going to change. And it's going to change because while yes, there will be inflows, so there's no doubt about that. In fact, last 6 months, if you see the debt inflows by FPIs, nearly about $10 odd billion, has actually been greater than equity inflows. So I'm just talking about September inflows since September till now, right? Sure. So debt inflows have been larger. But then at the same time, when the playground is changing, which means that the same debt flows which are now entering, they will also be scrutinizing India much more closely from a macroeconomic standpoint, especially from a fiscal and a debt management standpoint. So it could potentially lead to a situation where you will be vulnerable, or maybe you will be scrutinized much more closely by some of the foreign portfolio investors. So essentially, it means that you need much more insurance. If you are going to be scrutinized more, you need more insurance. And that is the reason why probably RBI is giving that indication that it is going to amass or keep on amassing reserves as the opportunity arises. So yes, net, I think present stability, but keeping in mind some sources of future anxiety, which could be a potential case. I guess the RBI's current state of caution will likely continue.
Thanks, Vivek. That was quite insightful. I'll have one question for each of you on how corporates should manage their treasury right now, and then we'll move on to Q&A. So, Tanushree, this question is for you. Since you are a net importer, and the present stability in rupee obviously helps you to kind of hedge your imports both on very low forward premium, low wall, so you can buy cheap options, and as well as rupee is coming down, so probably you can gradually build your hedges. But given that current market is pretty stable, how you actually look upon hedging your imports, and how far you want to kind of hedge your imports into the future? You're on mute.
Sorry. Great question, Pankaj. I think let me give you two perspectives. And this is largely because you asked how far do you hedge imports, right? So let me give you two perspectives. In my role before Lakshmi Organics, I was with a company where we were a net exporter. And there we actually had extremely large contracted out businesses. And in that case, whether the market was stable or the currency was bullish, what we would do is, and in both cases, whether it was here or there at Lakshmi, I think the first principle is to look at imports and exports at a gross basis and not at a net basis. Yes, there is natural hedging that you can operationalize, but when you're considering hedging, consider at a cross level. So what we used to do in my previous organizations was, because we had contracted out business, we knew with a 75% certainty what amount of export would be coming in. We would do a rolling sales hedging. And there we would even go up to 12 months. So, what we would do is we would hedge 12 months out, but not 100%. You start with a smaller version. So the closer the month, the higher you are hedged. And the outer the month, the lower you are hedged, but you start your rolling hedging so that you're constantly earning on the forward premium, right? And there, in periods of volatility, what one would do is one would try to maximize in the operations a natural hedge that one had. In Lakshmi, before I say what we are doing today, I think let me go back to 2022, when the real volatility in the rupee started. And because we are a net importer, and we are a net importer by a significant amount, and we also had a small part of an ECB that was outstanding at the point, our approach was to go in for 100% hedge. The analysis, so prior to that, we had a policy where we would hedge 70%, leave 30% open to Treasury's discretion, right? And there we were also using options. We were not using just simple forwards. But I think there were two learnings that we had. So we did a 10-year analysis, and the learning that we had was that over a 10-year period, we don't really gain much by A, using options, right? B, for the amount of effort that the Treasury spends on this 30% in a volatile environment, this 30% is not giving us any more benefit, but potentially increasing the risk appetite beyond what it needs to be. So we went into a 100% hedge using simple forwards, right? Now, today, the scenario is where we are continuing to hedge 100%. But I think we also now recognize that there is the potential of forward premiums increasing. And that may be in the second half of the year, right? But with our exports also looking to go up, we will still be a net importer. Because import hedging will become more expensive for us, does it now make sense for us to start moving away from this 100% hedge strategy and deploy another strategy which would make natural hedge more operationally real time for us and help us gain some benefits? So I think that's the one angle that we are looking at. The second angle that we are definitely looking at is, and it's not just today, even earlier on, that we have a basket of currencies. So you don't want to then sort of, and I'll give you a very concrete example, right? Somebody actually highlighted this to us when we were exporting to China, that we were being silly and not importing in the Chinese yuan, because we were missing out the forward premium benefits over there, which were way beyond the dollar, and we were exporting in dollar. And suddenly we started looking at it from a business point of view, and we said, this makes sense. So now, the other thing that we do is we're looking at our basket of currencies and saying, how do you manage this basket of currencies to generate the most optimal solution? I think that's the second methodology. And I think the third methodology is to basically ensure that we work with banks that give us the best exchange rates and the best, yeah, absolutely. So I think those are the three things that we are doing. The fourth thing, which I'm going to say, both in my organizations, we've been mid-cap companies, right? And in one case, we used to do the entire hedging internally. And in the second case, today, we do work with advisors. I think the reason is understanding the complexity of the business. So today, it's not just FX that we deal with, we also deal with the commodities market. So the minute you start dealing with commodities and you start dealing with the FX, you're dealing with two volatilities at the same time. The treasury capabilities that are needed, both from a people standpoint and from an infrastructure standpoint, requires us to be at a different level, because we are not there, we are working with advisors. In my previous organization, where business was relatively simple, we didn't have that complexity, and we understood our hedging process very normally. It was always done internally. So I think the other thing to weigh about is, do you want to be insourced? Do you want to have somebody who can guide you? And I think two brains are better than one. So, especially when business is complex, it makes worth the while to just work with people whose core competency is advising you on volatility and FX and hedging in the markets.
Thanks. That was great. So looking probably into the near future, maybe you will start looking at less than 100% hedge.
I think, Pankaj, it would only make sense, right? Because why would we want to? We would want to operationalize a lot more of the natural hedging, right? So move away from the 100% hedging, stop paying for the higher forward premiums, deploy the forward hedges, natural hedges that are there, and hence just have a better cost structure for the treasury.
Understood. Thanks so much. Vivek, a question for you, slightly different aspect. See, recent times, while we have seen dollar rates or dollar inflation rates have been quite sticky, right? It's not coming down as significant as one wanted to be. And at the same time, we have seen gold going up. We have been seeing even Bitcoin going up. Probably that's a reflection of dollar weakness. How do you merge both this? Do you really see dollar index weakness in near future, or you see that it will be sticky for some more time to come?
It's a very $1,000,000 question, Pankaj, because I guess a lot is riding and in the current global financial market setup on this question, what happens to dollar rates and dollar on the FX side as well as on the fixed income side. Now, yes, I do agree that given how rates have been, especially in the last few quarters, some of the commodity and the pseudo commodity in the space, like especially gold and maybe Bitcoin, as you said, have behaved in a slightly different manner. Maybe here there are two things which are playing out. I'm just trying to voice my thoughts. One is the expectation that we are at peak rate and going forward rates are going to come down. You and I and most of the market participants sitting here will probably over a cup of coffee sit and debate whether the easing is going to happen 3 months down the line or 6 months down the line. But I guess from a yearly perspective, most of us would agree that by the end of the calendar year, we could be at a somewhat lower level of interest rates globally than what we are at this stage at this point in time. So that clearly gives some boost to some of the risky assets globally, equities, commodities, items like bitcoins, etc. The other aspect which could be playing, especially in case of commodities like gold and Bitcoin, is global uncertainty. We've seen global economic uncertainty increasing since 2016. That was a time when actually Trump came to power in US. And since then, global economic uncertainty has been increasing. We've seen tremendous degree of deglobalization. Countries are started to impose trade restrictions, whether they are in the name of technology, whether they are in the name of climate change, whether they are in the name of trying to protect domestic industry. I think whatever be the premise, post 2016, the world has been in a different orbit as far as globalization is concerned. In fact, we are regressing rather than progressing. And post 2020, I guess the orbit has changed as far as protectionism is concerned. And the Russia-Ukraine war was, I would say, the final nail in the coffin, because it took the trade war into the capital market space, into the capital account space, and said that, while yes, all those trade wars are fine, now we are talking about a different scenario where the wars will also be fought in the capital account space. So what US and some of the, let's say, allies in the European countries did was that overnight they said that Russia cannot use its FX reserves, it cannot participate in the global payment system, the banks are almost in a frozen state, the Russian banks. So this sort of frigidity as far as the financial markets are concerned has led to a lot of introspection, I think, especially at an emerging markets level. And there has been a tendency which has been displayed by emerging market central bankers to buy gold. And this is also reflected. So it's not just a typical rate impact which is playing on gold, or the rate expectation impact which is playing on gold. This change in the geopolitical world order is also deriving demand for gold, and maybe to some extent fueling demand for some of the assets like Bitcoin. So I would probably say both are happening. Which is currently dominating which is difficult to say, but I guess we are in that state where both rates are having an impact as well as some of the change in geopolitical order.
Yeah, you are pretty much right. Russia-Ukraine war did actually trigger that kind of area where US kind of imposed capital control, but actually they kind of said that your reserves are like not useful anymore. You really think people will move away from dollar so quickly? Otherwise,
It's very difficult because the next available alternative, whether it is euro or in the developed country space or and pound to some extent, and the emerging market space, you've got CNY. The next available alternatives are way behind in the race. So even if, let's say, countries do make an attempt, I think that for that attempt to show in terms of perceptible decline in dollar status as a global reserve currency will take a very long time. Having said so, I would also say that the dollar status as a reserve currency has come up. So especially in the last 20 years, dollar status would have fallen by nearly 7-8 percentage points in global reserves. So that's the amount of decline in dollar reserves that global central bankers are holding. But at the same time, we've also got to think that a dollar is not just a trade invoicing currency. Dollar is also probably the most preferred currency for capital flows. So most of us typically look at the trade angle. There is also a capital flow angle which needs to be considered. And when you put both two and two together, the role of dollar appears to be much larger than what the trade angle tends to suggest. So it will take time because of the jolt that the current geopolitics has provided. And there are small steps which the countries will take. India has taken, China has taken, Brazil has started to take. But these are like a drop in the ocean, and it's going to take a really long time to have any perceptible impact.
thank you. Thanks, Vivek. My last question, and it is to Kunal. So while we spoke about the importers,
Right.
how do you see, or rather, what as a banker, like what you're suggesting to the exporter, like what kind of hedging strategy you think is most suited in the current scenario where the forward premiums are pretty low? At the same time, probably rates are coming off. So what's your thoughts around those?
So first of all, first thing is the aim of a corporate is to minimize the hedging cost in the longer term. So whatever strategy we suggest could be maybe for today. So the second point added to it is initially people or corporates used to have a static hedging strategy. Considering what was 6 months or 1 year back and considering what is the scenario now, the cause and lag effect is different. So you need to move from static hedging strategy to a dynamic hedging strategy. So there is no one strategy which can define you for next 5 years or not even next 6 months also to some extent. So answering to what an exporter should do. So I would say Rupee has been very kind as a currency because it is giving opportunity to both an importer and an exporter, irrespective of it being in a narrow range. So broadly, if we see the broader range is 80 to maybe 83.20, the broader range. We have seen 10 paisa plus minus both sides, but broadly it has been playing around those levels. So usually I suggest to go for a staggered hedging strategy rather than at one go, because some portions which I have back tested using options forwards as well, is some portion has to be hedged via options because it's kind of a double P approach, which means if it is going against, you are participating, and if it is like you're protected, and if it is in your favor, you can participate in that as well. Secondly, when forwards, you obviously as an exporter, you receive premium, and because the premiums are lower, though it is expected to move higher, forwards possibly with time may remain a preferable option. But my view on dollar rupee, first of all, comes before what I suggest. So as I said, my view on dollar rupee is probably more on the appreciating side with a stop of maybe 83.30. So my suggestion for an exporter would be if we are getting levels around 83, 83.10, though, as I said, we have seen 82.92 also yesterday and even today around those levels. So there are chances we get 83 plus levels where we should hedge 40% of our exposure using forwards as a tool. Remaining 60%, we should keep it open. If we are getting levels around or sustaining around those levels, we can use options for only 20% as a strategy, where if in case due to any uncertain events, if we are able to surpass that 83.30, because no one is certain. Ultimately, market is God. So that 20% is letting you participate on the right side also, even if it is moving higher. On an average basis, if I have studied the last 30 years of data, I have come to know that the average CAGR depreciation of rupee is around 4.25% in the last 25 to 30 years. Obviously, there may be some years it could be 11%, some years it could be 1%, but on an average, last 25 years, it is 4.25%. So considering that, 30% should always be left as an exporter to the market. I would recommend, or I would say that it's not necessary for an exporter to hedge 100% of his exposure. It's 40% by forwards at staggered manner, 20% by options, and remaining, or maybe 20 to 30% by options, and remaining 30% giving to market. On an average, 25 years of data, it has always been, helpful for an exporter, as rupee being a depreciating currency.
Understood. Thanks so much. Unfortunately, we're running out of time. We are actually overextended now. I'll take probably just one question today. Any more question, you can definitely drop us and we'll get back to you. So one question, if you want to ask question, you can raise your hand and probably we have taken all the questions that were of interest. So I'll ask Mr. Biju to kind of come and give vote of thanks.
Yeah. Am I audible?
Yes.
Okay. A very good evening to everyone. This is Sumant, co-founder here at First Basis. And on behalf of First Basis and QuantEco Research, I extend our heartfelt gratitude to all the distinguished speakers, Tyagu sir, Tanushree ma'am, Pankaj sir, Kunal, Vivek sir, and all the participants for sharing your valuable time and your valuable insights at this webinar. Before we leave, I just want to mention First Basis and QuantEco Research are collaborating together on this one-of-a-kind research report, which is called FX Periscope, which we believe will be truly useful for treasuries and traders across the country. In addition to that, Zen-Mastering the Trading Game, Batch 11, which is a brilliant training program led by industry best faculty, including Thiagu sir himself, will be starting very soon. So for those who are interested, please do contact us. The contact details are shared in the chat box. And on that note, thank you everyone once again, and have a very good evening.
Thank you. Thanks everybody.